Good evening. Welcome to Money Matters. I'm Charlie Shields, Wells Fargo Advisors, and my co-host today is Paul Sloate, Green Drake Partners CEO. How are you doing?
Good.
Good
How
to
are
see
you,
Paul.
Charlie? Good to see
No
you
complaints.
as well.
Life's good. Yes, sir. Well, we're going to have a two-man show tonight. We've got a lot to talk about, and I want to remind our viewers and listeners that this is taped, and so don't make any market timing decisions based on what they hear from us. We'll try to cover some interesting topics, but we're not tax advisors and we're not accountants, so we'll be talking about stocks and bonds, and please avoid market timing decisions based on what we have to say. So let's start with indexing versus using an expert like you to pick stocks in the market. Let's talk about which one is the best way to go, Paul.
Well, I think that's an it depends.
Okay.
It depends who you are, what your strategy is over the long term, and what your time horizons are. I think if you look at the period over the last, let's say, decade and a half, so last 15 years, if you indexed, you probably didn't get a great return. So since 2000, the market's up at maybe a 1 or 2% compound rate of return, I would guess.
Yeah, something like that.
Something like that. If you actually had somebody who actively managed against bear markets, similar to what went on during the 60s and 70s, then you did really well.
Okay.
Because active management made a big difference. So there's another point in time at which active management can make a big difference to the investor, and that's after the market's had a few good years and all the valuations have come up significantly. So if the valuations in the market have come up and you're not just buying the market because it's going to go up a lot, then if you have an active manager who can pick stocks, he can make a big difference.
Yeah.
And by the way, he can make a big difference over the whole cycle, but I think especially now. Because if you can add maybe 2 or 3% to your return per annum over a period of time and compound that over a very long time, then active management can make a difference. But we think especially now that valuations have come up, active management is going to make a big difference to the investor. I think at the same point where a tremendous amount of money has been indexed over the last 4 years. In fact, almost $1 trillion has been withdrawn from active money management out of the stock market since the bottom, which is hard to believe, and it's been reallocated to either fixed income or to indexing.
Yeah. Well, what a lot of people don't think about is if you index, you're going to make approximately 99.8% of what the stock market does if the indexes are properly indexing what they're supposed to, because you're giving up the friction, the 20 basis points for sure. If you have an active manager, you may or may not outperform the market. The other thing about it is the psychology that people tend to want to get out of stocks at a low point when they're scared. And if they're working with someone, if they have a manager that they're talking to, or if they have a financial advisor, then the two heads putting their heads together at a tough time might keep them in the market. You'll see these statistics that say that the average person in a mutual fund will average 3%, where the manager's averaging 8% over a period of time, because people tend to bail out at the wrong time, right?
Well, yes, and in fact, I can tell you we dissuaded several of our clients from bailing out right at the bottom in the beginning of 2009.
Sure.
We had several clients who came to us and said, we should be taking our money out of equities and we should be putting it into cash. And what we told them was that the market was incredibly cheap, the Federal Reserve was doing the right thing, and if they really wanted to do that, why don't we wait 3 to 6 months and then we'll reassess, and we can do this on a ratable portion over time. Of course, 3 to 6 months later, the market had rebounded 500 points.
And then they were calmed down.
And they calmed down.
Yeah, sure. Well, and okay, so indexing, first of all, you have to have some knowledge of where you want to put your money. If you're indexing, you can just buy the whole world market, but there are certainly times when one segment, like Europe or Asia, is going to underperform or outperform. And the question is, can a good money manager who's managing overseas see that happening? Or can a good manager in the United States see that one segment of the market is a place to be? And therefore get a tremendous benefit in performance over that person that just buys a world index?
Well, I think that you can. I know we've been doing this for 30 years, and we've managed to outperform the indices over 3- and 5-year periods of time consistently over a very long period of time. And so I also know there are very good managers for the international side of the equation. We typically focus on domestic stocks, who can choose which countries to invest in, which areas within those countries to invest in, and make a big difference between just buying, let's say, the MSCI World Index, which is the standard world index for international investing. And in fact, if you even look at this year, what you can see is some of the Asian bourses have done poorly, while the stock markets in places like Spain have done spectacularly well.
Yeah.
So if somebody with knowledge is able to pick being invested in Spain as opposed to being invested in, let's say, Indonesia, it makes a big difference.
Yeah. What my son and I do in our business, we feel there's certain segments of the market that we're pretty good at knowing which stocks we should buy and which ones we shouldn't buy. And then other sectors, utilities, for example, we don't know the best utility stocks. So we'll use a utility index in our managed accounts because that's an area where we don't feel like we have the expertise that we have in other areas. So how do you feel about that approach?
Well, our general approach is where we don't have the knowledge and expertise, we tend to avoid investing in those areas or choose other people who have that expertise.
Yeah.
I mean, nobody can be an expert in everything, and anyone who claims that is an expert in nothing.
Sure. So you look for a manager who is an expert, can outperform the market in utilities, for example, as opposed to using an index.
That's correct.
Okay.
And we tend to pick managers who may not necessarily be available to the general public.
I see.
Because we generally don't buy mutual funds for our clients, but we'll allocate monies to people who will have individual stocks for them, and we'll have a different type of arrangement.
So a separately managed account where they actually own the stocks.
Correct.
Let's explore the advantages of that for a minute. If you own a separately managed account and you also have some mutual funds, just to make a case, mutual funds will spit out a capital gain. And the advantage if you also would have a separately managed account is you can go through and find the losers and take those off and wait 30 days and buy them back if you like them, and you can watch the taxes for a client. So I feel there's an advantage to a separately managed account over a mutual fund that you control the tax situation, if you will.
Well, yes, you can literally manage the tax situation. You can avoid many short-term gains. You can basically push in the long-term gains through the SMAs, and that enables you to effectively give the investor a higher after-tax return than the investor otherwise would get.
And that's becoming more and more important as the tax laws change. There's many people this past year that were shocked to find out their capital gains rate is more like 25% or possibly even higher because there's some extra taxes from Obamacare for people above a certain income limit. It's now 20% capital gain instead of 15%. So you add all of that. And if you take a short-term gain, as you were just talking about, then you're paying at your tax rate, which could be as high as 45%.
Correct. So I think that the tax efficiency is going to become a bigger and bigger issue as we go forward.
All right. Well, let's talk for a minute about the concept of asset allocation. There are a lot of different ways to do it. Some people just say once a year they will rebalance, whatever. There's other people who don't really even think about it, but suddenly they'll look at their statements 5 years later and realize, gee, I was 65 years old, now I'm 75. Because the stock market's gone up, I have suddenly got 85% in stocks when I shouldn't have that much. So do you do something for your clients to try to keep them aware of what their asset allocation is? How do you work that?
We tend to pay attention to that asset allocation, and in particular client cases, we'll recommend rebalancing on an annual basis.
Okay.
We try not to let things get totally out of whack.
Yeah.
And a lot depends also on the client goals
Yeah.
and their age. So if I have a 50-year-old that's gotten a little bit out of whack, well, that's really okay.
Yeah.
But if I have somebody who's 70 who's out of whack, well, that might be a different issue where I might want to suggest they rebalance.
And today, I'm not timing the market with what we're talking about here, but in most cases, people probably have more stock than they realize they do if they don't pay close attention, because the stock market has more than doubled over the last 5 years. So how would you handle that asset allocation if a client says, gee, I'm now 85% or 90% in equities? What kind of bonds would you be buying to prevent any losses in this shaky bond market?
Well, first of all, we wouldn't go very long term. We'd probably keep it 5 years and shorter, because interest rates are going to go up over the next few years. So I think that's one thing. And secondly, we'd suggest a bond ladder where they would own different maturities, and as maturities became, and as rates went up, their bonds would roll down and become shorter in maturity, and then we just go and buy a bond that was maybe 5 years. And so they'd collect higher and higher coupons as the bond market went up over the next few years, but they wouldn't really be hurt with principal loss because the bonds would become very short in maturity.
Sure. Okay, if you look in your crystal ball, do you think there's a point at which you'd want to go out on maturities? Do you have a certain interest rate in mind where it might be appealing to go out to the 10 or 15-year maturities?
I think there will be a point in time to do that, but I don't think it's for a while. Yeah. It might be 2 or 3 years from now. I don't have a number in my head because there are so many what I would call uncertainties in the marketplace.
Yeah.
But I think the big thing that I would watch is what the Federal Reserve does and the point at which they're going to start what I would call raising rates more aggressively. Okay. To slow the economy in a meaningful way.
Yeah.
And that's the point at which I would probably look to maybe extend that duration, where I thought that maybe the Federal Reserve was at the point where they might want to cause a recession or something.
Okay, so back in 2009, we were looking at, with the fear that was in the market, we were looking at price earnings of maybe 10 generally for the market. And now let's say we're up to 15.5 or whatever it is. And a lot of times markets overshoot. The rule of thumb I've always believed in generally is 20 minus the inflation rate. So maybe PE should go up to 17 or 18. And if they overshoot to 20, and we've seen interest rates go up, let's say the 30-year government bond is at 5, and if PEs are at 20, well then 1 over 20 is 5. So stocks and bonds would both be paying you about the same thing. That would probably be a pretty good time to look to shift some money over into bonds, wouldn't it?
Well, I would say that if the market went to a 20 PE, you would definitely want to shift money into bonds. Okay. The market at the bottom was trading at 10 times depressed earnings, cyclically depressed earnings. Right. So it was a very attractive entry point, and if you looked at 5-year normalized earnings, you're only paying like 7 times 5-year normalized earnings, trailing 5-year earnings. So it was an extremely attractive point to enter. Today, the market's trading at a very high level of normalized earnings if we look at trailing 5-year earnings. So I don't think necessarily you want to exit the market, but I think you have to be aware that the valuation is not as attractive as it was, and that the gains you may have going forward are going to be less. And given that we both agree that interest rates are going to go up as the economy accelerates, you might want to think about maybe taking some of that stock market piece, maybe not reallocating to bonds, but maybe you could look at real estate or some other types of alternative asset classes that might do well despite rising interest rates.
Okay, and one other possibility we can discuss, how about Europe? Do you think Europe is a little cheaper than the U.S. right now? Should people be focusing some money over there?
Well, I definitely think Europe is cheaper than the U.S. It's about 3 years behind the U.S. in economic recovery. So Europe is about where the U.S. was in 2011. Okay. So if you think about what happened to the U.S. market since 2011, it's had a pretty good run.
Yeah.
So I think, number one, the valuations are cheaper. Number two, the earnings are more depressed. So the earnings could have a big rise if there's a real recovery. We've recently started buying a couple of ADRs that are European.
Okay.
And I would also say that there's a real possibility that the ECB may now enter some form of quantitative easing, just like the Federal Reserve and just like the Japanese Central Bank. And as we know, when the central banks entered those, both those stock markets took off.
Yes.
So I would definitely be looking at Europe.
All right. How about the emerging markets? They've had their troubles, and as a matter of fact, the last couple of years, while the U.S. market was going up, the emerging markets were going down. Is there an opportunity there?
Well, you've had a little bit of a bounce here in the emerging markets, and I just want to remind our viewers that this show is taped on a delay,
right,
and broadcast on delay. But there are fundamental issues in some of the emerging markets, and there are other emerging markets which are very well positioned to grow. Okay. So I think that you have to think about whether you're really interested in emerging markets, or maybe you want to look at what are some of the frontier markets. And then on top of that, you also have to decide what's your time frame. If your time frame is 2 years, you might want to look at some of the emerging markets and some of the people who can select within the emerging markets, because not all countries are going to be equal going forward. So some are going to do better than others, and some stock markets are going to do better than others. And you'll be better off with someone who can actually choose which ones are going to do better. But you might also, if you have a longer term time horizon, like 5 to 10 years, really want to take a look at some of the new emerging frontier markets that are basically going to be the economies of tomorrow. Okay. And one of those areas we definitely suggest looking at is Africa, where we think the economies are finally on the cusp of becoming real economies and meaningful in the global area. And what people don't realize is everybody thinks of South Africa as the biggest economy in Africa. The biggest economy in Africa today is Nigeria.
Wow, I didn't know that.
And Nigeria is growing very rapidly. And the currency has been relatively stable. And the monetary policies are generally decent. They do have some corruption issues. But what I think is that if you can find an investment manager who knows what they're doing in some of these frontier markets, whether it's Nigeria or Ghana or some of the other frontier markets around the world, and you have a long-term time horizon, you can basically participate in very high economic growth with companies that are trading at very low multiples of earnings.
It sounds like you've made the case here in your answer that, once again, indexing wouldn't be as good as finding a manager that knows what's going on and can pick out the areas that will outperform.
Yes, because especially in some of these frontier economies, a big part of the index is comprised of financial institutions that have come public. And they may not be the companies that you want to own to participate in that country's economic growth. Okay. So in that case, you really do want a manager who knows what they're doing.
Okay, terrific. Well, let's try to help one of our viewers here. We have Jack Mann says, are we going to have a currency crisis in the near future?
Well, I think the short answer to that is no, Charlie. The U.S. is not Argentina. Argentina, by the way, is having a currency crisis. Yeah. There's actually a dual exchange rate for Argentina. There's the official rate, and there is the actual rate at which the currency is transacting, which is much, much lower. And they also have 30% inflation because they've run horrible economic policies in the country. But for the United States, I don't see a currency crisis anytime soon. The U.S. is still the largest economy in the world. And even if we only grow 3%, that's a huge amount of economic growth. Our debt to GDP is still at a reasonable level. If you look at the consumers' debt to their assets, that's at a reasonable level. If you look at their what I would call financial obligation ratio, which is how much they're paying out in financial obligations, it's back to the lows of the early 1990s. So I think that the U.S. as a country is in pretty good shape. And in fact, if economic growth accelerates, which is what both you and I expect, I don't see any currency crisis for the U.S. near term.
Well, and I think one excellent example to show you how the U.S. stands around the world is when the Ukraine issue came up with the Russians, money flowed into the United States. It didn't go elsewhere. When people get nervous, they pour their money into the U.S. instead of into other areas. So I think you're right. The U.S. will try to keep their currency down, as we've talked about on previous shows, in order to keep exporting stuff to other countries, but we aren't going to let it fall out of bed. We'll just try to, in that competition, we'll try to keep it relatively low versus other countries, as they're trying to do to us, right?
Yeah, I would agree with that, Charlie.
Okay. So if you have a question, please send it in to Money Matters, 205 East Levering Mill Road, Bala Cynwyd, Pennsylvania, 19004, or if you prefer email, send it to moneymatterstv@gmail.com, and we'll get you a good answer like Paul just provided on this question. Let's talk a little bit about trying to help our clients in ways other than which stocks they ought to own. I know from time to time a client will come into you and they'll say, what's going on with estate tax planning? What are the capital gains rates going to do in the future? I think in the past year there were a lot of people afraid that they would drop it back down to $1 million that would be free of federal estate tax, and people were very relieved when they decided to make it $5 million. And now one spouse can pass $5 million onto the other spouse, so it's actually 10 that can be sheltered from the federal taxes. So I'm sure you get questions from clients, do you expect this sort of thing to continue? Do we have to worry about next year it'll drop down to $1 million? How do you advise clients if they're getting ready to sell a business or do something like that?
Well, I think if you're getting ready to sell a business, there's a lot of pieces of planning that go involved. In fact, getting ready to sell a business is a multi-year process. You don't say, today I'm going to sell my business tomorrow.
Yeah.
Because first, the business has to be ready for sale.
Mm-hmm.
Second, there are all kinds of estate and tax considerations in the sale of that business that you have to think about. So, do you want to set up trusts, maybe for your kids, where the trust owns a piece of the business, and do you want to transfer a piece of the business into a trust so that the kids can benefit from the sale? And there's all kinds of other things that you should think about before you go out and sell your business. And then you have to think about, do you want to sell it in a cash transaction, or are you going to take a piece of another business when you sell the company? So, for example, if you sell your company to a public company, you might want to take the stock because that may be a non-taxable transaction.
Sure.
So I think there's a lot of estate planning and tax planning issues that you really need to talk to a competent estate planning attorney, have to talk to a competent accountant who's familiar with business transactions, who can really help you to do the right thing. And then, of course, when you go to sell your business, you have to make sure it's ready to be sold.
Yes. I have been amazed how when a client is smart enough to get the accountant and the tax attorney and the financial advisor all in the same room, there's a synergistic effect that happens where each person can provide an input and make the end result a lot better.
Well, yes, because they're all experts in different areas that are actually complementary. So the output should be a better decision.
Sure. Now, just looking out over the horizon, do you personally believe that taxes are going to be going up even more in the future? Do you think that they'll be able to hold the line at the highest tax rate of 39.6 now, based on what's going on in Washington? I know it's hard to predict what's going to happen there, but it seems like we're starting to see more surprises on the upside in the revenues in Washington, so maybe they're through raising the taxes for a while. What do you think?
Well, I think they're through raising the taxes for a few years.
All right.
I don't think they're done raising taxes, and I'll explain what I mean. We're having a cyclical recovery in the economy, which is driving tax revenue. And there's going to be a point where the budget gets close enough to balance that Congress is going to start spending more money. And then, as we always know, we always have a downturn in the economy at some point at which we're going to have a big budget deficit.
Sure.
Okay, but that's just the cyclical component. I think the secular component is really the entitlement programs, because those are really going to start kicking in around 2017. So if you start looking at the demographics of what's going to go on, you're going to start seeing an acceleration in spending in the entitlement programs at the same time that the interest cost on the debt the United States has is normalizing, right?
Sure.
Because we've talked about interest rates are going to go up, and Uncle Sam won't be able to issue 2.5% 20-year paper. They're going to have to issue 4.5% 20-year paper.
We hope it's only 4.5.
And we hope it's only 4.5. It might be 5.5.
Yeah.
So if that happens, what's going to happen is the entitlement spending and the interest cost on the debt are going to create a massive squeeze on everything else in the budget.
Sure.
And I think it's going to force a real debate about the limits of entitlement spending, because if the entitlements are not brought under control, what will happen is, number one, the government's tax take of the economy will need to go up significantly. By this, I mean the federal government's.
Yeah.
Even after they've shifted a lot of costs to the states, if you were to look at state tax rates today versus where they were in the early 90s, you'd see that they've almost doubled.
Sure.
And they've almost doubled because the federal government has pushed onto the states certain costs that should have really been borne by the federal government. So that's one thing. But the other thing that's going to happen is, if there is no change in any of these programs, there won't be money to pave the roads, there won't be money to do any scientific research, there won't be money to do anything that's really necessary for the growth of the country and the economy. And so what you're going to have is, you're going to have a real debate about the limits of the entitlements and how much we as a country can really afford to spend as a percent of GDP on some of these entitlements. And I think especially that's going to happen in the medical area. And
Yeah.
Social Security is sort of self-funding, but I really think this is going to come down to Medicare, Medicaid, and limits of spending on health care.
Sure. When you have what's happening with Social Security and what's happening with Medicare, and then when you look at the type of people that seem to be signing up, the unhealthy, the elderly, there'll probably be a huge surprise out there in the out years for how much has to be spent there. So it sounds like there'll be a good place in people's portfolios for tax-free municipal bonds going forward, if we're allowed to continue to have that tax-free status. I get worried about that sometimes, but I think it would be very difficult for them to change that overnight, because it would damage the value of municipal bonds for elderly people if they did it so quickly.
Yeah, I think that basically the demographics and the vote of that demographic will prevent a major change in that.
Well, let's end it on a reassuring note. So I appreciate the chat. I think we provided some interesting information to viewers and listeners. We hope you'll tune in for our next show. Dave Ebner and Brian Kohut will be talking about some investment ideas. I think it's really important to stay tuned in. Some of you want to invest by yourselves. Some of you want to use a financial advisor. I think you should do the latter, but at least tune in here, because as far as we're concerned, your money matters.